Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. Today is episode number 240. Tax time is here. Now what? All right, Jake Cross, welcome back to the show.
Thanks for having me, Cory. Always happy to be here.
I appreciate you taking some time to join me here today. And for our audience watching and listening at home or out and about, my voice, of course, is a familiar one from the show, but it is not Jake. I am pinch hitting for Jake as he is traveling here today. And Jake Cross, a certified financial planner from the financial planning team at Falcon Wealth Advisors, is joining me here today to talk about now what? Now that tax time is here. So before we get into all of that, Jake, though, just I know it's been a little while since you've been on the show. Just kind of fill us in. What's going on with you? What's new in your life?
Yeah, Cory, I think this week or this year is really the year of weddings. It seems like I have 4 to 5 lined up for the remainder of the year. So it's going to be a busy season with traveling, and I really enjoy going to people's weddings. So I'm thankful for that. But yeah, it's the year of weddings, it seems like.
Very good. Where are you traveling to for weddings?
One in Denver, one in DC, one in San Diego, and a couple others here locally.
Wow. Okay. So you do have weddings all over the place. You've got the country
yeah.
covered. That's good. And we just went to a wedding a few weeks ago. Matthew Tomlin, another one of the financial planners at Falcon Wealth Advisors, who just returned from his honeymoon in wine country. So very good, Jake. I'm glad 2023, it sounds like, is the year of love and the year of weddings. So safe travels. Thank you for being here today. For everybody, again, watching and listening at home, please make sure that you subscribe to the show. That way you'll never miss any new episodes when it comes out. Of course, we appreciate a 5-star rating or a thumbs up if you think the content is worthy, of course, of that. But let's go ahead and just jump right into it, Jake. We were talking before the show today around what the real concept and theme of what we were going to highlight was. And we've had a number of conversations with clients, of course, this year in 2023 around tax year 2022. But we really wanted to spend some time today talking about what's the next step for people as far as financial planning and tax planning goes. Now that we're at this point where tax returns are due, people are getting them filed, people are either getting liabilities or refunds. So we're going to talk through all that today, Jake. And I think just to kick us off here, from your perspective, what is the most important pieces of information for clients to be aware of when they are looking at their tax return?
Yeah, it's a good question. And I also think a very loaded question.
It is.
Everyone's tax return is going to be somewhat the same, but also very different because we all have different jobs, different amounts of income, maybe different sources of income, which you could see on these different schedules of a tax return, which have their own set of complexities. But, I think one that everyone comes across is going to be obviously their marginal tax bracket and the effective tax rate. And really the effective tax rate is really the percentage of tax owed based on their taxable income. And the marginal rate is really going to be what the next dollar of income is going to be taxed at. And I think it's really important, obviously, for a ton of different reasons, but one in particular that I think, everyone comes across as people are investing and contributing dollars for a short-term financial goal or even long-term like retirement, or even folks that are in retirement and they're drawing income from these assets potentially. But it's going to be the breakdown between contributing pre-tax versus Roth and using someone's tax return to help understand where they are today, and also using their financial plan to understand where they might be in the future. And I want to emphasize the might because, we're talking about the future here. It's a little bit difficult, but we can use someone's projections in their financial plan to have the best educated guess, if you will, on what their situation might look like in the future. But really, it's important to understand, should you be contributing pre-tax dollars to retirement, or should you be contributing after-tax and Roth dollars to retirement? And really, it's going to be a breakdown between what the tax rate that you're contributing those dollars at is, and then what the tax rate would be when you withdraw income from those different vehicles. And I think using your tax return is crucial in that scenario.
That's good, Jake. With that being said, though, a tax return, right? I think for virtually anyone that's gone through the process and has filed one themselves, or if they're just taking a look at the return that their accountant files for them, there's a lot of information there. There's a lot to decipher and try to uncover. How would you kind of instruct people? How should someone go about finding the information you're talking about here today?
Yeah, so you typically, if you're working with a CPA, they will list out a summary, if you will, of what the tax return is. And if you don't, our tax planning process will do the same for you. So we'll talk more about that here in a little bit, but you'll be able to see what your taxable income was and then what the actual tax owed is. And that would be, what your effective tax rate. And then your marginal tax bracket, you'll fall based on your taxable income in between those thresholds. And there'll be a tax rate associated with that. But I will say that tax returns are definitely, they can range from 12 pages to 100 pages. And so there's a lot to look at. So it's important to work with a financial planner or wealth advisor or CPA to look through it because, the tax code is not easy and they definitely don't make it easy. So I wouldn't go about it by yourself, but it is important to review your tax return every year and make projections for going forward.
Exactly. And I think that it's important for people to understand also that it is something that should be done on an annual basis. Rather than assuming that it's something that, the tax situation is what it is and it will continue to be that way into the future because people's situations change, the tax code changes. There's a lot of different goals and, everything else can change as well. So it really is a good discipline and exercise to go through on an annual basis to understand there might be some years, Jake, where it makes more sense to contribute more pre-tax dollars to a 401k. And the next year, it might make more sense to contribute more Roth dollars to a 401k. Or for someone who's retired, understanding, are they withholding taxes from their Social Security payments or not? Is the state that they live in a state that will tax a pension or their Social Security or not? Should they be taking distributions from an IRA or a Roth or a brokerage account? There's a number of variables involved. And I know there's a lot of different puzzle pieces here that are relevant, but I think that's a great way for us to kind of get this kicked off, talk about what's most important for people to understand. And quite literally at this point in time, in the year, this is a great time to be proactive about planning for the remainder of the year, because I do know that there are a lot of people whose accountants, when they go to file their returns, they'll tell them the things that they should have done last year. But the reality is it's not that useful at this point. So this is the point to talk about what should we be doing between now and the end of the year. So I think just to kind of move past that, I just want to talk about, I've gotten a lot of questions from clients as we work through tax planning around people that have large liabilities, a lot of money that they owe to the IRS, or clients that have large refunds, Jake. So can you just talk about what should you do if you have a large tax refund? Let's start there.
Yeah, so the conversation between tax refund or owing taxes, at the end of the day, assuming everything else equal, you want to have a net zero, right? You don't want to have to owe anything, and you also don't want to get anything back because it's a little counterintuitive, but by getting dollars back, that simply means that you paid too much throughout the year and you gave the government dollars that you could have had otherwise throughout the year. And it turns out they're not paying you any interest on it. So it's almost like an interest-free loan to the government if you get a refund. And then, owing is never fun, right? I don't think anyone, at least I don't know anyone, that is happy if they woke up and they filed taxes and their CPA is like, hey, by the way, you owe $5,000, right? No one's going to be happy with that. I will say, though, if you know that you're going to owe and you do some tax planning, right, because you're being proactive, which is what you should be doing, then if you have a dollar in mind or a dollar that you might owe, let's plan for it, right? You might be able to buy treasury bills and get some return on those dollars as opposed to just sitting in cash, and then matching up the maturity date with tax time, and then that bond matures, and then you go and pay your taxes. So there's a variety of things to do, but like I said, it's a little counterintuitive, but you really don't want any refund, and you don't want to owe anything. It should be the goal.
Yep, that's good, Jake. We were talking kind of offline before we started recording the show here today, and I made a comment to you that I think a lot of people view tax refund as a reason to celebrate. From our perspective, it's really not so much a reason to celebrate, but it's a mistake in the sense that it just means that you paid more tax than you needed to. That money could have stayed in your pocket instead of the government. So I think just reframing it that way is useful. But from my point of view, Jake, I think also though, if somebody has an unexpected refund or an unexpected liability, it's a good opportunity to evaluate why. We talked about, of course, it has to do with, generally speaking, either you paid in too much or not enough, but to understand, if I'm retired, Jake, maybe I am taking distributions from my IRA, I'm withholding taxes, I'm receiving Social Security separately, but maybe I'm not withholding any taxes from my Social Security. Depending upon my total taxable income, I very well may owe income tax on that Social Security income. And if I wasn't withholding enough from an IRA to cover that, ultimately that's going to result in a liability. And the reason that we talk about this with clients is just to help them understand the big picture and to help clients understand what we want to evaluate and review for them and our tax planning process, so we can help to ultimately reduce the number of unexpected surprises, Jake, I suppose, in either direction. And that kind of goes more into our tax planning process specifically. So can you, I know, Jake, that you have been working with the financial planning group to really kind of map out what the tax planning process will be for this calendar year. Can you just kind of walk us through that and help people understand how we approach this for clients at Falcon Wealth Advisors?
Sure. So it's been an awesome process really to help build out. And, we've been doing tax planning at Falcon Wealth Advisors, but we've definitely revamped the process. And a internal initiative of ours is, while we are growing, we want to maintain the quality level of service that we've been giving our clients.
Of course.
And in fact, we actually want to go deeper. And so what this tax planning process allows us to do is to go deeper and create more value for our clients and really fine tune their tax planning process for them. But really what we'll do is, we'll proactively reach out to gather tax returns right after folks file. So we can take those in, and we have our tax planning software, like you mentioned, and it allows us to do a variety of things, which has been awesome to use. But really the huge benefit, I think, is we can actually create models. And so we'll take in those tax returns, we'll scan it in securely. It'll put out about a 2 to 3 page report of some highlights or observations, like I mentioned earlier. Really summarizing some of the tax situation for the year prior, which I think it's always good to look back at the years prior to see what changes can be made for the future years. But really what we can do is then start to create and build out tax planning models where we might put in some various assumptions of, okay, well, this client might increase their income from W-2 by this amount. They might have a huge liquidity event. Let's say that they work at a public company and they got acquired and they had a ton of company stock, equity compensation that maybe got accelerated with vesting, and they had a huge liquidity event, huge taxable event. Well, we could plug that in and start to build out a model of what they potentially might owe and the effects of that. And then throughout the year, I think it's important to do tax planning year round, all year, because things change. Especially if you're a business owner, things are constantly changing. Income is a little bit harder to estimate just because it's more variable. But then in the second half, or I guess the beginning of the fourth quarter, we'll practically reach out again to meet with some folks and see if they want to go through it together and take them through a full one-off meeting of purely tax planning. And we'll use the tax planning model in conjunction with their financial plan to say, hey, how can we lower taxes this coming year, but also how can we lower their taxes over their entire lifetime? Because I think that's one thing that, and not talk bad on CPAs, I really enjoy working with CPAs, but they are more backward looking, and it's important to be forward looking as well, because 1 year of taxes is not as valuable as lowering a lifetime of taxes. So it's really important to understand that while you might pay taxes more today, that's setting you up for much lower taxes for many years to come.
Yep, that's really good, Jake. And I think that ultimately taxes are going to get paid one way or the other, which we all know. And it's more just a matter of optimizing how much we pay and when, and over the life of someone's financial plan. But that is something that we want to be proactive about and something that we've been working through with clients for a few years now at Falcon Wealth Advisors. So we want everyone to know that we very much have a plan and a process in place so we can continue going deeper as far as the tax planning goes. One crucial element that I think I should mention here is that our intent is not to give people specific tax advice. Our intent is not to replace anyone's accountant or CPA. The idea is the tax planning we're doing should really be in conjunction with what someone's tax professional is doing. But the whole idea is, being proactive about planning is going to be helpful for all the professionals involved and for the client. So I think it's really smart to really to take advantage of this software, this offering that we have at Falcon Wealth Advisors, because we found a whole lot of value. And I don't know about you, Jake, I'm just curious, have you found, I know that I've seen a few, I'm curious, have you found anything that's been interesting or compelling on someone's tax return that has prompted some type of more significant action that we may not have known about otherwise without that return?
Yeah, there's been a handful of things. One topic in particular is any errors on someone's tax return, because again, the tax code is not a simple kid's book, right? It's a very complex, weirdly worded book, and that comes with its own challenges. And so sometimes things might not be clear on how something should be filed or reported as such. And sometimes you find that in someone's tax return. So we've had a handful of folks that, have had just not huge errors. There's been one or two decently sized errors, but some errors where they can go amend their tax return and actually get money back. One that's pretty common that I've seen is, if we do a backdoor Roth contribution and we make a non-deductible IRA contribution and then convert those dollars to Roth, it's called the backdoor Roth contribution strategy. Some folks don't put it as a non-deductible contribution. So then when you convert, it gets counted as taxable income. So that's it's a very common but small minor thing that we've came across. But that's another thing that's important about this tax planning process, is that we can have a conversation with someone and let them know and actually map it out. Hey, we're doing this. This is the impact of it, and this is how it should be filed. Also note, double check everything with your CPA, right? Because we're not CPAs, but it's important to go through this so you can actually help educate the client. They can actually see the numbers, because it's different, because we can pull it up on the screen, right? It's different than just saying, hey, we're going to do this conversion. It might be around this. They can actually see the numbers and see the impact. And I think that's super valuable for them.
Yeah, I agree completely, Jake. And one other item just to mention here, when we talk about the usefulness of going through this process for clients and what can really be gleaned from it that could be, actually put into place for people to help their situation. I think a perfect example, last week on the show on Upticks, Caprice Black joined Jake and I, and we talked about health insurance. And we talked about Medicare premiums, Medicare Part B and Part D, and how those are largely driven by taxable income. So for clients that are retired, that are on Medicare, understanding how much wiggle room they do or don't have as far as their taxable income goes before Medicare premiums become more expensive. I don't think that's the end all be all, but I do think from a proactive tax planning standpoint, if we can help to minimize those costs, that's a great thing. But frankly, we don't want to be, penny wise and dollar dumb, in that we aren't taking money out of any accounts for someone to live comfortably in retirement because they don't want to pay for healthcare, only to have to take a lot more money out of accounts later when they have to take required distributions. So again, there's a lot of moving parts involved, but that's an example. And I think, Jake, also, along with, like you mentioned, you guys have found where maybe the backdoor Roth contributions haven't been reported the way that they should be. I've had experiences with clients where we've looked at their average tax rate, their capital gains rate. People have had tax years where their capital gains tax rate is 0%, which means if they have assets that they can realize capital gains on and keep it below a certain threshold, there's not any capital gains tax due on those dollars, which again is a very real, very positive situation for a client. It's not going to always be relevant for everyone in every particular year, but it's something that we can find going through this process. And because again, if I personally, if I can realize capital gains at 0%, I want to be able to make sure that I do that each and every year that I can. And I'm sure, Jake, it's the same for you and for the rest of our clients. And that is some of the information, frankly, that can reveal itself when we go through this process. So With that being said, Jake, what are just some larger financial planning or tax planning considerations from now through the end of 2023? What do you think people should really be doing, thinking about, and looking at?
Yeah, I think there's a ton, but really it's going to boil down to your overall situation. And I always hate saying that, but it just depends on their situation. But I think, at the start of the year, it's important to review your employee benefits, especially if you've maybe moved to a different company or maybe got acquired to a new company. One example might be that your new company might provide something called a mega backdoor Roth contribution, which would be within your 401k plan. You could do after-tax contributions within the 401k plan and then convert those dollars to Roth, subject to some limitations. But typically, you can put in substantially more money into a Roth vehicle than you could with a Roth IRA using the mega backdoor. So that's something I think that you won't find unless you talk to AHR or go through your employee benefit package. And the one thing that is new starting this year that had occurred at the very end of last year is that the Secure Act 2.0 came out, and there's nothing in there that's making huge changes for one particular thing, but there's a ton of different changes. And so one that I think everyone eventually will come about with is required minimum distribution age is going to change. And so if you're getting closer to that required minimum distribution age, which is either going to be 73 or 75 now, if you haven't already been at that age, and you want to do Roth conversions, well, you have potentially more years to be able to do that. And so that's something to look at, right? And then from a tax planning perspective, if you might owe quite a bit this year and it might be an ongoing thing, well, you might need to do estimated tax payments, and you can use the safe harbor rule to calculate how much you need to do bare minimum to not have an underpayment penalty. So that's something I would do, especially while people are filing their taxes. It's right there in front of them. Maybe if you want to meet with us, go through tax planning, we'd love to do so with you, and we can help map out what those might look like to make sure that you get closer to a spot where next year you don't owe anything, but you also don't get anything back. And so I also think it's important to note overall some changes in the future. One, the Secure Act 2.0, like I mentioned, but two, the Tax Cuts and Jobs Act is going to sunset starting 2026. So some of those tax laws prior to that act are going to come back into play. And of course, something can, a law can get passed to change this. But as of now, it's set to change, and a variety of things will change. And so one of which that everyone's going to get impacted by is tax rates are going to get adjusted up slightly. And each bracket's rate will go up around 3 to 4% roughly. And so that's something to take note of, right? Because taxes are going to go up in the future potentially. You might put more contributions towards Roth than you would otherwise. So it's just something to take note of. And of course, always talk with your CPA about it and I'd like to take you through our tax planning process to fine tune some of those numbers.
Very good, Jake. Thank you. And that's a lot. That's a lot that you just threw out there as far as the considerations go for people. And I think the real kind of takeaway, and that's all very useful information. I think that, the real takeaway for people though, is that we have a process in place to help work through this with clients at Falcon Wealth Advisors. And right now, from this point forward in 2023 is really the time for us to be having a lot of these discussions and to be working through these items because we can be proactive and work to eliminate as many of the unexpected surprises as possible. And I think, Jake, one point that I wanted to make here that's pertinent for a lot of the clients at Falcon Wealth Advisors, because so many of them are retired and are taking distributions from retirement accounts, is if you have a large refund or you have a large liability and that you owe to the IRS, I think it's a great time to reevaluate how you're withholding taxes. And if you're still working, and the same is true, that's just as pertinent. If someone's still working, how much tax are you withholding on your W-4? If someone's retired, how much tax are you withholding when you take IRA distributions? And the reason I bring this up is because if someone's getting back a $5,000 refund from the federal government when they file their tax return, and they go and put that money in their bank account, or they go and put that money, or they go and spend it on whatever they may go and spend it on, that ultimately results in that client spending more money than their financial plan may indicate. And I think this is a really important point for people to understand too. That ultimately it can influence someone's long-term plan. If they're over withholding and getting more money back each year and turning around and spending that money, that ultimately means they're spending more money than they're taking out of the account. It's just a matter of when it comes back to them from the government and how they spend it. So I just bring all of this up because I think it's all relevant and pertinent for people to understand. It's important to continue to work through the financial planning and tax planning process year in and year out. We know the tax code is going to change. The Secure Act 2.0, like you highlighted, Jake, just went into effect. We've seen the required minimum distribution age change, 3 times now in the last 3 years. Yep. Certainly job security for us. And I suppose it's important for people to understand that nothing is set in stone and is going to be fixed the way that it's going to be in perpetuity. And it's a good idea to be fluid, to be flexible, and to be proactive. So you can ultimately optimize the situation, optimize to the downside how much money you ultimately need to pay to the IRS, because we're all going to pay our fair share, but our intent is to keep it limited to clients for just that. Let's not pay any more than that. Any closing thoughts, Jake? Anything else you want to add here today?
One other thing that you mentioned, we talked about getting a refund and dollars owed. Just to piggyback on that, right? If you are getting a large refund, that also just means that there's less dollars in your retirement account potentially growing, right? So it's only going to hurt your plan if you're withholding way too much. Of course, we don't want you to have to owe anything, but again, I think that's a crucial thing and very common thing to go over what you're withholding from taxes and help plan for what projected income will be to see if we need to raise that or lower that to help prolong your financial plan.
Very good, Jake. Thank you. Last question for you. When you file your own personal tax return, Jake, would you rather get a refund or would you rather owe money?
I would rather owe, and here's my reason. Because if I'm doing tax planning throughout the year and I know that I might owe, let's say it's $5,000, $10,000 or whatever it is, then I can buy treasury bills, for example, that are yielding pretty attractive rates at the moment and put that money aside, let that money get a little bit of return while I wait for tax time to come around and have those bills mature or bonds mature and pay the tax and not have to worry about it, right? It's in a safe vehicle and it's still getting a little bit of interest. And I think I'm going to be better off over the long run by doing that consistently.
Very good, Jake. Thank you. Spoken like a true financial planner. I like it. Earn a little bit, ultimately earn that interest on your own money instead of letting it sit in Uncle Sam's pocket, not earning any interest for you. And as we know, there's been enough stories over the last few years of people that have struggled with filing tax returns and getting refunds. I very much fall in the same camp as you, Jake. I would rather owe than ultimately have a refund coming back to me. But at the end of the day, that's going to be personal preference for a lot of people. But I really think it's just, if nothing else, it's important for people to understand the impact that has on their tax return and on their financial plan. I do think that is about all the time that we have here today. Jake, thank you again for taking the time to come onto the show. Thank you, everybody at home and out and about, for watching and listening. What we've covered here today, really in summary, tax time's here. It's time to be proactive about planning for the rest of the year at 2023. Clients at Falcon Wealth Advisors know that we have a tax planning process and a tax planning software in place for us to use. And now's the time for us to have these conversations. I know it feels early in the year. I know we just got through filing our 2022 tax returns, but the more proactive and the more that we anticipate what things are going to look like, the less surprises there will ultimately be down the road. So again, Jake, thank you for being here. Everybody at home watching and listening, thank you. Have a great day, and we will see you next week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.